Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, July 7th, 2025 edition. Let's get started. All right, we start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons. Our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. It was a holiday shortened 2-week period, and the stock market basically went straight up. We grew at a whopping 5.22% for the 2-week period, which brings our year-to-date gain to 6.76%. If we look over the course of the last 6 months, since we just ended June, we hit some all-time highs back in February, and then, of course, all the talk about tariffs on Canada and Mexico, and then everybody else in the world started hitting the news, and we had about a 20% drop here in the beginning of April, and then since the tariffs were delayed and the economy has been more resilient than we thought it might be, stock market has basically just been powering higher ever since. As we move on to interest rates, we look at rates that are measured by the bonds issued through the U.S. Treasury Department. We think that interest rates are the preeminent measure of investment risk, and they're factored into every calculation and valuation for other assets, like stocks. So if rates are going up, we usually see stocks go down. If rates are going down, we usually see stocks going up. And we've got our interest rates listed over here on the left, maturity lengths on the bottom, and each of these points represents an interest rate for a given maturity length. The solid green line is where we ended the week. Brown line is where we were 1 quarter ago, and the dotted green line is where we were 6 months ago. The last 2 weeks, pretty much unchanged. So I didn't bother sharing that first. But we've got very little change here on the short end of the interest rate curve. Federal Reserve has kept interest rates steady for the entire year, so not a lot of change on short-term rates. The medium term, very interestingly, dropped significantly over the first 3 months of the year and have come back up a little bit. There was a lot of concern about recession with all these tariffs and trade deals potentially causing us to spill over into a recession, which then leads to more people buying bonds as protection for those types of events. But we can see here on the long end, we've pretty much maintained or gone back to where we were at the start of the year. And we anticipate that the 10-year interest rate will also drift back up closer to where we were at the beginning of the year. All right, we'll come back to this chart of the S&P 500 as we talk a little bit about what happened over the last 2 weeks. It was a little bit quieter of a 2-week period, which is why I think we saw the stock market mostly rise throughout the 2 weeks. We did start off coming off the U.S. bombing Iran. So that first Monday, markets were a little wobbly, but it didn't look like there was going to be any significant retaliation. So the market ended up being okay coming out of that. The only real significant decline that we saw was here on Friday the 27th. That was when President Trump abruptly ended trade negotiations with Canada over a digital tax. That got resolved over the weekend, and then we pretty much were on the rise after that. It felt like most of the headlines were dominated by the big, beautiful bill that did get passed on the 3rd, and President Trump signed into law on the 4th of July. And then this weekend, we got another report that oil supplies should be increasing even more than we thought starting in August. So interesting to say the least. As far as economic data, housing is still kind of a mixed bag. We got reports that existing home sales were up, but home prices were declining a little bit. Mortgage applications were up. When we saw interest rates decline coming out of this attack on Iran, I think a lot of people were out there trying to take advantage of those lower rates. and we saw an increase in mortgage applications. Pending home sales were also up, but new home sales were down, and construction spending was down. Manufacturing sectors showing a little bit of decline in activity. Services sector seems to be holding up okay. We did get a final reading of our first quarter GDP, which came out at a minus 0.5%, which was lower than originally reported. But our personal consumption expenditures, or PCE inflation reading, came in at 2.3% for the year-over-year period, which is very close to the 2% that the Federal Reserve says they're looking for steady or stable inflation. As far as the consumer is concerned, personal income and spending were both down in May. Consumer confidence continues to decline here in June. But our weekly reports of initial jobless claims and continuing claims still remain at relatively normal or healthy levels for this economy. We had an employment report from ADP, the payroll processing company, that suggested employment might be down in June, but the official payroll report came out on Thursday and was better than expected, and our unemployment rate fell to 4.1%. We did also have an increase in job openings and a decrease in layoffs. So it looks like the consumer is doing okay. At least they're still employed. Whether or not they're making as much money or spending as much remains to be seen. And what are they spending their money on really is the question that I have, because those are the companies that we want to be investing in, is where people are spending their money. All right, for our investment expectations and implications portion, we'll say that we're cautiously optimistic about the current state of the economy and the stock market. Um, Headlines in the last couple of days suggest that Iran is not letting inspectors into their nuclear facilities. We hope that that does not escalate into more attacks to get them to comply. As mentioned, the market was a little wobbly on the 23rd of June, right after the US made the initial strike, and we think that if this escalates into something larger, that the markets would react negatively to that. It feels like the stock market has been powering higher, almost unabated, in the last 3 months since the tariffs were delayed. We know that the stock market does see declines of 5% about 3 times in a 12-month period. And yes, we had a 20% decline from February to April. But we still think that there could be something coming. I mean, we're up over 20% from the bottom that we had in April. And that's a very short period of time to rise that far. Like the whole downward trend and then reversal has been pretty significant and by historical standards. So it wouldn't be uncommon or unusual for us to then kind of take a breather, have a small decline in the market for us to kind of recalibrate and readjust our positioning. Having said that, we've been actively rebalancing into the end of June, beginning of July. We've been trying to sell off some of those positions that have done well and either reinvest them into other areas or hold the cash, anticipating that we're going to have a short-term decline. We think that this week, with President Trump presumably coming out with final trade negotiations or trade deals, tariff levels, that this could spark a sell-off. We'll say 3 to 5% decline in the stock market. We think that the levels that he originally suggested back in April are higher than what is going to be the final product. We think that this bill, this big, beautiful bill, is going to allow him now to look at what the deficit is going to be between revenue and expenses. There was a lot of negotiation in both the House and the Senate trying to find some common ground. And so the deficit is going to be larger than if it had gone through the way President Trump wanted it to originally. So he now needs to try to make up more money through tariffs. So he's got some deals in place, or at least some frameworks in place. We don't have a lot of details, but he's been pretty clear about sending letters to other countries and just basically telling them this is what you're going to pay. So we think the market is going to respond negatively as we get closer to July 9th and those letters go out and those announcements are made. Again, we don't think it's going to be as bad as April, but we are expecting it to be a little choppy, a little bit of volatility. and we'll see if it gets to a point where President Trump comes out and says, okay, well, we'll modify the rate again, or we'll delay it again, or whatever, just to see if that is enough to call his bluff, I guess. As far as interest rates go, we still think that the Federal Reserve is going to cut rates 3 to 4 times this year, or 0.75 to 1%. Nothing has been handed out so far through June. We don't think it's going to happen in July. We wouldn't be surprised to see a 0.5% reduction in September and December, or 0.25 in September, October, December. So we still think that there are reasons, justifications for the Federal Reserve to make cuts to interest rates. We think that the economy is okay, but there are signs of declining activity that, and it would be nice to get ahead of the game instead of reacting to worse information. So we hope that they will come on board with our perspective and make those changes. Finally, we're about to start quarterly earnings reports for the second quarter. A lot of companies adjusted their earnings outlook, or they suspended it altogether because of all the uncertainty with tariffs. So we think that the earnings reports that they're going to be giving for the second quarter will be better than we anticipated. So their stock prices will go up on that information. We also think the final tariff deals are going to be less than were announced in April. So they'll be able to provide us with some forward guidance that will look better than we thought in April. So, we're seeing some justification or some reasons why we think the stock market will continue to grind higher. It's just a matter of, how much the headline risk is going to play into it with tariff announcements and everything this week. So we still have some geopolitical events, still have some conflicts, some wars that we're trying to get through and end around the world. So a lot of things still in the pipeline that need to get taken care of before we would be 100% full steam ahead. But we're still, again, cautiously optimistic and think that things are going okay for now, and we're happy with the positioning that we've got for your accounts. Okay, as a final word, I attended a barbecue at my parents' house to celebrate the 4th of July Independence Day holiday. My mom asked us to bring a leafy green salad, which we did. I also spontaneously made a Jell-O fruit salad that kind of looks like this one here on the screen. I mix up some cream cheese and Cool Whip and sugar. Add in some pre-made Jell-O, usually strawberry Jell-O, and then mix in some fresh strawberries, raspberries, and blueberries. Blackberries would be fantastic as well. Um, and I think it's a delicious way to get my daily fruit intake. My wife, however, told me that she usually doesn't eat my fruit salad because I like to use the full fat cream cheese and full sugar Jell-O, and um, just everything in my recipe is going to be full calories, basically. And I ended up leaving about half of the berries separate so that there could be a low calorie version of a fruit salad that was not covered in the creamy, yummy goodness that I prefer. Which got me thinking a little bit about investor preferences. There are some people out there who really like the full fat, full sugar version. They want full volatility with the investments that we use, and they want that high risk, high reward experience. But I've got other investors who are either retired or just in general don't want a lot of risk with their investments, and they're that low calorie, low volatility option. And I like and I appreciate all the different perspectives and reasons for why people prefer to invest the way that they do, and gives me an opportunity to get outside of my box of how I would invest for myself, and incorporate other things to make sure that we're making your accounts work the best for you. So appreciate your patience while we make some adjustments and rebalance and get everything the way that we want it to for the foreseeable future. And we're happy to work hard for you. I do have some family stuff scattered throughout this upcoming week, so I'll be in and out of the office, but I should have cell service everywhere I am. So if you have something come up, let me know, reach out, and I'll make sure you get taken care of. And also, we'll be starting to compile quarterly reports and getting those out to you as soon as possible. So that's all I've got this version, and I hope you guys have a great week, and we'll see you soon.